Today on InvestTalk, we cover the historic losing streak of the Dow Jones Industrial Average, talked about the market today, answered questions on Civitas and the energy sector broadly, one on dividend reinvestment plans and one on ticker MTW, then ended the day talking about the advances in nuclear energy.
This is InvestTalk, independent thinking, shared success.
Let's keep things moving and move straight to my main focus point, which is about the Dow Jones facing its longest losing streak since 1978, and after today, its longest since 1974. Now, the Dow Jones Industrial Average just marked its longest losing streak since 1978 yesterday. On Tuesday, the Dow closed down 267 points, or 60 basis points, marking 9 straight days in the red, now 10. The last time this happened, Jimmy Carter was in the White House. But despite the length of the streak, the losses have been relatively mild with the exception of today. Over the 9 trading days, the Dow is only down about 3%, hardly a market meltdown, though down again another 2.5% today. A major contributor to the Dow's losses is United Healthcare Group, which has dropped 18% this month. The sell-off started after the shooting of its CEO, Brian Thompson, and intensified when President-elect Donald Trump vowed to tackle drug industry middlemen. Investors were also eyeing the Federal Reserve coming into today, which was expected to cut interest rates by a quarter point, and they did, though they did offer some more hawkish guidance, which we will discuss a little bit later today. But overall, the Dow is still up this year and remains about 1,100 points higher than it was on election day. The post-election surge reflected optimism over Trump's promises to cut taxes and deregulate, but as many are warning, investors will soon have to weigh both the potential benefits, but also the risks of these policies, including his threats to raise tariffs and ramp up deportations. Still, though, the losing streak isn't necessarily a red flag. It could be more about profit taking after a strong rally. But regardless, anytime something like this happens, there needs to be a cautious reassessment of what our priors are, of what Trump's second-term policies could mean for growth. To find a longer losing streak than this, you'd have to go back to 1974 when the Dow fell for 11 straight days. Let's see what happens tomorrow if we break that. But with the economy still strong and the NASDAQ and S&P generally holding up after this post-election surge, many investors aren't really hitting the panic button yet. Let's wait to see what happens over the next week or so. Let's wait for the market to continue to digest the comments from the Fed, the ensuing Fed speak that will happen over the next couple of weeks. And as earnings continue to come out, what companies think for 2025.
Get ahead in your financial journey. Sign up for the KPP Premium Newsletter and receive tailored insights every week.
Let's talk a little bit about the market today and what a day it was. U.S. stocks were really a lot lower in trading today, near worst levels following the decision and press conference from the Fed. S&P posted its worst session since early August's yen carry trade event. The NASDAQ had its worst session since early August as well. Russell 2000, actually its worst day since June of 2022, while the Dow posted its 10th straight decline, making it its longest straight decline, or rather its longest streak of declines since 1974. Overall, Dow down 258 basis points, 2.58%. S&P 500 down 2.95%. NASDAQ down 3.56%. Russell 2000 down 4.39%. All sectors lower, though big tech a key drag. NVIDIA not as bad, but Tesla really the top decliner today, driving the indices downward. EVs, REITs, regional banks, credit cards were the worst performers of the day. Healthcare services, telecoms, dollar stores among the outperformers. Though, again, just because you're outperforming doesn't mean you're positive. So really the least bad performers of the day. Treasuries under pressure with the curve seeing some bear flattening, the 2-year back above 435 basis points or 4.35%. Highest it's been since late November. Dollar up strong, 1.1%. Gold finished down 30 basis points. And all of this is because something we'll talk about a little later on, which is the hawkish Fed rate cut being really an overhang following the earlier bounce attempt with rates seeing broad upward pressure. Backup in rates was really from the expectation for a less aggressive Fed and deficit concerns, which has been flagged as one of the factors behind the recent deterioration in overall market breadth. S&P decliners outnumbered advancers for the 13th straight session today, the longest streak since at least 1978. Other excuses for the weak breadth really revolved around stretch valuations, AI tailwinds, and worries about the implementation of tariffs early next year. While more noise than news out of Washington when it comes to the funding bill, there's also some political drama that could play into not necessarily near-term market weakness, but more of an indication of potential worries in actually getting legislation done in 2025. Guidance language out of the Fed was tweaked in a hawkish direction, and Cleveland's Fed President Hammack actually dissented, preferring to hold today. SEP, the Statement of Economic Principles, takeaways also leaned hawkish, with the median dot plot for 2025 and 2026 up 50 basis points, and the long run dot up about 10 basis points to 3%. In addition, 2025 headline inflation forecast jumped 40 basis points to 2.5%. So overall, the market digesting what news we got, what data we got from the Fed, and certainly moving forward in the coming days, we'll have the market digesting it a lot more.
Hey guys, good evening. It's Larry down in South Florida. I had a question about a stock, MTW. The company is Manitowoc. It's a small cap industrial crane maker. Just kind of curious about where you might see a company like this fitting in, considering all the trade and tariff talk of the new administration. Thanks, guys. Take care.
So the Manitowoc company, that's ticker MTW, is exactly what the caller said. It is a company that manufactures cranes and other products that help lifting with construction. Now, it is a small cap company. It's about $328 million market cap, and it has quite a bit of debt for its size, about $512 million in debt. So more debt than the value of the company's equity. The cash flow is negative, has been oscillating between negative and slightly positive over the past 5 years. They do not pay a dividend. Their profitability is really all over the place, and their earnings have been consistently downgraded over the last 6 months. And so you can ask, okay, what effect may tariffs have on this kind of company? And certainly it could affect the construction industry. The cost of lumber could go up. The cost of suppliers within the construction industry could go up. And therefore, maybe the amount of projects go down and revenue falls for a company like Manitowoc. But we can really ignore that. And the reason why is because this is a company that is not, as far as I can tell, very healthy. Right? Its relative strength since 2018 has been pretty abysmal relative to the S&P 500. Year to date, it's down 46%. Over the past 52 weeks, it's down 43%. And a lot of that has nothing to do with tariffs. It has to do with revenue, which has fallen year over year from 2023. It was $2.2 billion, projected to be $2.1 billion this year. And these margins that are all over the place, oscillating from negative to positive to negative to positive to negative. It was 1.8% net margin last year that shrunk all the way down to 40 basis points. And so I think that the question is irrelevant to the answer here. And the answer here is that Manitowoc is a company that does not have or has not had a bright year. Driven by that collapse in revenue, driven by the narrowing of those margins, almost breaking down to zero here, right? Their EBITDA margin's only 5%. EBIT margin's 2.9. Bottom line, 0.4. And so for this company that has more debt than value of its equity on its balance sheet, I'm going to have to pass. And not because of tariffs, but because, you know what? Growth just does not look good. Thanks for the call. As promised, let's go to Chris from Maine, who has a question about Civitas Resources. Do you own it or are you looking to buy it?
Yeah. Hey, Luke. Well, I want to start out. I've talked to Justin a bunch over the years and Steve a bunch, but this is my first time chatting with you. So thank you very much for everything you do. I really appreciate it. You guys have really changed how I go about investing.
Well, thanks for calling in. It's a pleasure to talk to you for the first time.
Yeah, thanks. So I own Civitas. I own, a slew of oil and gas stocks. I got into them, 6 to 8 months ago on a dip. And then they dipped some more, so I bought more. They dipped some more, so I bought some other categories. Civitas is my largest holding, followed by Conoco, Phillips, and then a few others. But I'm just curious. I know you guys own a couple of those and some others. How are you guys playing the oil and gas? I just know, where they're down so low and then supposedly drill, baby, drill, that might be overblown. But I'm just kind of curious, as a sector in general, how are you guys playing that right now where it's down so much?
Well, that's a great question, and something we actually talked about today. And the reason why is because you take a look post-election and you look at the price of oil companies, you look at XLE and you see its pullback pretty much from the election until today, right? You saw it riding high and then falling back down. And you look at the price of crude oil and you think to yourself, well, this doesn't match up, right? Crude oil is pretty much flat. You've seen oil coming down, oil energy companies rather coming down now. And so what I was pointing out today when we were having this discussion is pull back to the past 3 months. And what you see over the past 3 months is the gap between where energy prices are, where oil prices are, and where XLE has moved is actually a lot narrower. And so the reason why I think that is, and you hit on it a little bit on that drill, baby, drill, is that in the wake of Trump's election victory, there was a lot of excitement for the energy industry, right? Drill, baby, drill was a key part of his campaign push. But over time, what the executives have said, namely at Exxon, right, has said that, well, you can say drill, baby, drill, but we're kind of doing fine on the supply side here. What we want to do is increase the efficiency of getting our product to market, make it cheaper getting to market, right? There's still a lot of permits out there that these companies aren't even using. And so over the past couple weeks, what I see this movement down in energy, at least over the past couple of weeks, is kind of this return to the reality of what is facing the industry, in that the largest headwind is actually from demand, right? You're seeing Chinese demand still being downgraded. And so that's really affecting these energy companies. But if you, again, pull back on the 3 months, you see there's not really much change from what we see here, or rather, since September, you don't see much change relative to where the oil prices are moving. So I think overall, it kind of escaped the normal supply and demand dynamics of oil broadly. Now, for us, something we've talked about on the show more recently is, given what the industry wants, right? Given what the industry wants, we think that natural gas is a good place to be within the energy sector. Now, Civitas is about 80-10, maybe 80-20 breakdown between crude oil and natural gas. But for a oil company, it's in an area where we like, right? They're in the Permian Basin. This company has very strong dividend, very strong cash flow yield, and can pretty well oscillate between where it wants to devote much of its activity between natural gas and crude oil, depending on what kind of tailwinds are pushing energy prices. And so for us, what we've been doing is moving more towards those midstream names, more towards those natural gas names, towards those companies that could benefit from increased efficiency in getting products to market, still keeping some of our oil exposure, but tilting more towards that natural gas segment of the energy sector. Does that all make sense?
Yeah, it does. Yeah, it's a great breakdown. So I really appreciate it. Thank you very much.
Awesome. Have a wonderful day, and thanks for calling. Can't wait to hear from you again. I hope you've checked out, and I hope you've also been telling your friends and family members to check out our InvestTalk YouTube show, because we put this audio podcast in video form over on our YouTube channel. Just search InvestTalk with 2 T's. And while you're over there, if you have a question that you just cannot wait to ask, feel free to leave that question in the comment section. This one from Jim Leahy, our good friend Jim Leahy, says, DHI or KBH? Do you think DHI or KBH would be a good buy after their recent pullbacks? Let's start with DHI. DHI is a home builder. It is a very large home builder. It's about $53 billion market cap, though down to about $47 billion actually today. It's about 3.37% today. Year to date, down 6%, down 28% over the past 3 months. Now, its revenue growth is pretty stellar, going back 5 years, right, from $16 billion to $36 billion. And that's even grown from September of 2023. In that time, margins have expanded as well, though notably lower than the 17.5% net margin in 2022, now down to 12.9%. In terms of debt, they have about $5.9 billion in debt, again on a $47 billion market cap company, but they're continuously buying back shares. They have a solid dividend yield of about 1% is where it's been over the past 5 years. And that dividend has grown from 50 cents a share to $1.20 per share. In that time, though margins have been contracting, cash flow has been improving, though they've hit a little bit of a hitch this year. Let's take a look at KB Homes. KB Homes is also a home builder, though notably smaller, about $5.3 billion market cap. In terms of debt, they have $1.7 billion in debt. And they also have been buying back shares. Their dividend is also solid at about 1.4%. And cash flow has taken a hit this year, just like the previous company, D.R. Horton. Now, keeping in mind, D.R. Horton. Now, its sales grown at slower pace, about 7% on an annualized basis. And net margins have also contracted from about 11.8% to about 9.4% this year. So looking at both these companies, what we have is a situation where one is more profitable, one has had less of a fall off in revenue, one has had less of a fall off in terms of their margins, one has more cash, one is lower leverage. And so if I'm choosing between these two companies, I'm probably going to pick the one with more growth and the one whose price to earnings looks a little bit better, right? KB Home or D.R. Horton's forward-looking price to earnings sitting at about 10 relative to its average of about 9, whereas KB Home is sitting on a forward-looking price to earnings of about 7 relative to its average of 7.2, about 8 relative to its average of 7.2. So there's really not much of a difference in terms of the valuation of these companies relative to where they've been. But you know what? One has better growth. One has a less leveraged balance sheet, though neither of them really have much to concern about. And one also has a lot less short interest, 8% for KBH. Also interest coverage of 1.4, so noticeably more leveraged than D.R. Horton. So if I have to choose between the two, I'm going to go with D.R. Horton. That's ticker DHI. We appreciate you watching.
Don't forget to like this video and subscribe to our channel for more content.
Hello. I was wondering if you have a portfolio around like 35 stocks and like 30 of them are enrolled in DRIP. Do you recommend keeping stocks in DRIP or taking the cash dividend and purchasing additional shares as you go along? Thanks. And thanks for all you guys do.
So for those of you who do not know what a DRIP is, a DRIP stands for Dividend Reinvestment Plans. And essentially what happens when a company gives you a dividend in cash is you can elect to automatically reinvest those dividends in shares. Now, why might you want to do that? Well, it happens faster. Rather than waiting for the cash to get through your brokerage account and to your brokerage account, you can spend it. If you're going to buy the same shares already with those dividends, well, then you would probably just want to use that dividend reinvestment plan. Another thing that is beneficial of it, well, it's automatic. Again, if your intent is to continue to reinvest dividends from a company in those companies' shares, then it makes sense to just use DRIPs because they're automatic, they're faster. You can just set it and forget. But the problem here may be that if you have DRIPs in this case, where you have 30 of the 35 stocks have those dividend reinvestment plans, the 5 don't, well, then here's the downside, right? You could get out of balance. And so in this situation, I think it really depends how balanced your portfolio is. If you intend to buy those shares, no problem in using the DRIPs because, again, it's automatic and it's faster. You get the benefit of compounding faster. But oftentimes things get out of whack, things get out of balance. It may make more sense if you're the type of person that wants more control, has a more active than passive portfolio, to rather than use the DRIP, to take the cash instead. Thanks for the call. Let's make it 2 in a row. This one from 888-99 chart.
Good morning, InvestTalks. Today I'm calling about a Hershey, ticker symbol HSY. It's currently about 1.8% of my portfolio, and I'm currently adding slowly to reduce my cost basis. I know they face challenges with the price of cocoa and sugar, which from what I've read, they're short to medium-term issues weighing on the business. But I was also thinking about other challenges, such as RFK Jr. I also noticed Mondelez attempted an acquisition, but given the price movement after the news, it doesn't appear that's going to take place. As of today's price, I do believe that it's undervalued, but please let me know what you think about the risk to reward ratio. Thank you. I'll be listening on the podcast.
So the Hershey company, ticker HSY, is a candy, sweets, confectionery company. Very large, out of Hershey, Pennsylvania, $36 billion market cap company with a little bit of debt, but not too much, only about $5.6 billion in debt. They're a dividend payer. They have a 3% dividend yield right now, and their dividends per share has grown pretty consistently in the past 5 years from $2.76 per share, projected to be about $5.26 this year. Now, as well as paying that solid dividend over the past 5 years, they have also been buying back shares. About 210 million shares outstanding 5 years ago. That number is now 202 million. So not a significant amount of shares, but still buying back shares nonetheless. Their cash flow is improving. Their margins do look pretty solid, even though they did have some strain from the price of cocoa, as you mentioned, right? Their net margin is still 16.5%. In terms of the relative valuation, well, they're sitting at about a 21 times forward-looking earnings, which is below their 5-year average. And you did mention something that did come up in the past couple weeks, and that was the potential merger from Mondelez. Though about 5-6 days ago, the news did come out that the Hershey company did reject that offer. And so the question is, right, given where the potential movement and policy is in the next administration, what does that mean for a company like Hershey? The broader point here is you have differing and competing ideologies here, right? You have the potential next Secretary of the Agriculture, who's very much in favor of deregulation. You have RFK Jr., who may be head of HHS, right? All these people have to be confirmed. And he is in charge of what would be stiffer regulation, monitoring and controlling what people can consume, what ingredients are in products. So then the question becomes, okay, well, if the guy who's in charge of Health and Human Services, which is the primary focus of medicine, the FDA, versus agriculture, looking at the food supply chain, having differing opinions, who really wins out? And we don't know the answer to that yet. But with Hershey, I think what you have is a company whose revenue has really fallen off. Their revenue growth has fallen off in the past 3 years. So this is more of a growth fall-off story where it's still trading at a high-ish multiple given where growth has been over the past 3 years. So I'm less hesitant to invest in Hershey given its struggles, its idiosyncratic business-specific struggles, and less because of what could be prevailing policy changes. So I'd keep it on my watch list. I just don't think now is the right time to buy Hershey. Thanks for the call. I already briefly mentioned it, but the Federal Reserve has just signaled it may be nearing the end of its rate cutting cycle after agreeing to a quarter-point reduction today. His latest cut brings the federal funds rate to a range of between 4.25% and 4.5%, the lowest it's been in 2 years. But Fed Chair Jerome Powell acknowledged this decision was really a close call and hinted that future cuts will be approached cautiously. How did markets react? Well, we talked about it. Markets were broadly down. The Dow Jones fell over 500 points or 1.3%, while Treasury yields were rising, and that was midway through the day, right? The Dow finished down about 2.5%. New projections show Fed officials expect inflation to be stickier next year, possibly influenced by the incoming Trump administration's policies. As a result, they've penciled in just 2 rate cuts for 2025, down from 4 in September. The Fed has already cut rates by a full percentage point since September amid signs of a cooling labor market, but now inflation remains stubborn, with core consumer prices still rising at a 2.8% annual rate. And wage growth and job gains, while slowing, are holding steady enough that some Fed officials believe the economy may not need much more easing. Adding more uncertainty to the mix are Trump's proposed policies, including tariffs and stricter immigration controls, which could drive prices higher. Economists predict tariffs alone could push core inflation up by about 30 basis points in the next year. And so if that happens, the Fed would understandably have to hold rates higher for longer to keep inflation in check. Investors who once bet on a steady pace of rate cuts next year are now less confident. Futures markets are pricing in just 2 or 3 cuts in 2025. Long-term borrowing costs like mortgages and auto loans also will remain elevated, and sectors sensitive to interest rates like housing are feeling the pinch. The number of newly built homes for sale has climbed to a 15-year high. So despite these challenges, the overall economic picture is still pretty robust. Inflation-adjusted income growth remains strong, profit margins are still healthy, and the job market is looking more and more stable. But with inflation refusing to fall below 3%, Powell and the Fed are signaling caution. So for now, the era of steady rate cuts may be behind us, and instead we may be having to think about higher or steadier for longer. Let's keep things going and play another question from the InvestTalk listener line. This one coming in from Ohio.
Dave from Ohio. Hey, I really appreciate the broadcast. Calling about Prudential Financial, PRU. I picked up a small position a couple days ago. Just get your opinion. If I should add to it, I'll be listening. Thanks.
So Prudential Financial, that is ticker PRU, is an insurance and investment company. And we've got a lot of calls about Prudential, I think, this year. I think I probably answered this question 2 or 3 times. And the reason why is because they had some pretty solid growth at one point. Now it's a pretty big company, right? It's about $43 billion dollar market cap company as of today. It's down about 4% over the past 3 months. And so with all of that, what does growth look like? Well, net income has risen, projected to rise from $2.4 billion to $4.8 billion this year. That's pretty solid. They have about $28 billion in debt, not too crazy for an insurance company, but cash flow is noticeably fallen off since 2022. Now, their dividend yield is very strong, about 4.37%, which is about where it's been over the past 5 years. So nothing out of the ordinary there. Though it is notable that their payout ratio is about 74%. So that certainly means that down the road, there could be some strain, but still everything looks pretty solid on that front. You know, one area that we've been trying to look at is how to get more exposure to the financial services industry. And I think insurance is a good way to do it. This company is really on the high end of liquidity in terms of insurance companies. And overall, their forward-looking price to earnings has dipped near their 5-year average now. From 8.1 is where it is now. About 7.7 is their 5-year average. Now, before this, they're up about 10.49% this year, only up 11% on the 52-week. But overall, I think that we're getting to a point where maybe after today, Prudential becomes a buy, right? It's at $114 per share right now. And the consensus target price amongst brokers that cover it is about $131. And I think the reason why Prudential had done well over the past couple years is because their annuity business had grown so substantially. And should they continue to be able to grow that business, well, now could be a good time to get into Prudential. I still think there may be a little bit of downside risk within financial services over the next couple weeks. So for now, I would keep it on my watch list. But overall, I do like Prudential. Thanks for the call.
This is Tarun. I'm calling from the Bay Area. Thanks for the show. I wanted to get your guys' take on Williams-Sonoma, ticker symbol WSM. Just wanted to get your guys' take on it, if it is a good time to buy and start a position in this holding. Thank you, and you have a good day.
So ticker WSM is Williams-Sonoma Inc. It is a retailer for more of the higher end home good products, though not everything they sell is expensive, but a lot of their stuff is higher end. Now, one thing that I like about this company is it is an exceptional retailer with a really good brand that has customer loyalty, and they're really good at utilizing investor capital, right? The returns are very solid. The return on equity, 53.5% this year. Return on assets, 20.5% this year. Their margins have expanded from about 10% in 2021. Project to have a net margin about 14.3% this year. Now, it's a $24 billion market cap company that also has very little debt, only about $1.3 billion in debt. Over the past 5 years, they have bought a bunch of shares back from about 180 million shares outstanding, projected to be about 120. No, that was 160. Tough to read sometimes. 160 million shares outstanding to about 120 million. Now, they do pay a dividend that has oscillated between about 1 and 2.5% over the past 5 years, but their dividends per share has grown from 86 basis points all the way to about 86 cents per share, all the way to about $2.02 per share. The revenue growth was also pretty solid. We headed into 2023 from $5.6 billion in revenue to $8.6 billion this year, though that has dropped off a little bit, but net income is projected to grow from $950 million to $1.083 billion this year. Overall, I think that this company has had a heck of a year, right? Up 84% year to date, up 86% over the past 52 weeks. And we do hold it for some of our clients. But where we are right now, the company's down about 6% today, though most of the market is down pretty broadly. And with that being said, well, it does look a little expensive. It's trading at the upper end of its 5-year range. But the past year's had incredible momentum. In the past 3 months, it's had incredible momentum. And what we do know is that typically stocks that have momentum tend to continue to exhibit that momentum in the short term. So if you already held it, I would say maybe we see where this momentum goes over the next couple weeks, over the next couple months, and start to trim down. I would start to trim down if you did already hold the position, but is now the time to open a new position? I think that the answer to that is keep it on your watch list. Thanks for the call.
For more insights and resources, visit us at InvestTalk.com.
For our last question of the day, let's dip back to the YouTube channel comment section question bank. This one on Prudential versus Old Republic International Corporation. It says, I have full positions in PRU and ORI. I feel like I should just choose one since the two of them are similar. I'm having a difficult time choosing between the two. Any help or insight would be appreciated. Great program and concept. Love the show. So we already went over Prudential for the caller question. So let's dive into Old Republic. Now, Old Republic is an insurance company as well. Their growth looks a little bit worse pulling back on the 3-year than Prudential does. And I think the big key here for this $9 billion market cap company, so substantially smaller, is that it operates in a different area of the market, right? Prudential focuses more on the global insurance market. They have a lot more exposure to international markets, whereas Old Republic has a lot more focus on the domestic market. Now, just like Prudential, this is a solid dividend payer. Dividends around 3%, so notably a little bit lower than Prudential, but still, their payout ratio is only 46%. They have room to expand that dividend. Their cash flow also probably looks a little bit worse over the past couple years than Prudential does, and their debt looks about the same, right? They are not in any danger in terms of the leverage of their balance sheet, just as Prudential is not. And so, they're both insurance companies, yes, but just because they're in the same sector doesn't make them the same company, right? Prudential focuses on a broad range of products, life insurance, annuities, investment management, as well as those classic insurance products, whereas Old Republic really focuses on property and casualty insurance. They have a strong presence in the title insurance market. And so if I had to choose between the two, right, a lot of that growth within Prudential was from that annuity business. They have a more broadly diversified business. And so when you have some of the problems that you get within the insurance market, well, Prudential being also in the investment area more kind of gives them that diversification, which can give them growth from that business. So if I had to choose between the two, I would choose Prudential. Thanks for the call. Or rather, thanks for watching the video. Now, nuclear energy is a hot button issue these days. And a nuclear energy startup chaired by OpenAI's Sam Altman has just inked a major deal that could reshape how data centers power the future of artificial intelligence. Oklo, a California-based company developing small modular reactors, signed a 20-year agreement with Switch Inc., a major data center operator, to supply up to 12 gigawatts of clean energy. For context, that's enough power to support all 7.6 million households in the state of New York. While non-binding, the deal is finalized, right? The deal could be worth billions. And frankly, it's a pretty bold bet on advanced nuclear energy, which is increasingly being tapped to meet the massive energy demands of the AI boom. Small modular reactors, or SMRs, are designed to be more flexible and cost-efficient compared to traditional nuclear plants. And Oklo's first 15-megawatt reactor is set to go live in late 2027. This deal follows similar moves by other big tech giants. Amazon, Google, they both signed nuclear power agreements with X Energy and Kairos respectively, while Microsoft recently inked a deal with Constellation Energy to restart the 3 Mile Island plant in Pennsylvania. Now, these partnerships are somewhat critical for the tech sector's electricity demand. Renewables alone can't meet the constant high power needs of AI systems, which prompted the pivot to nuclear reliability. But there are some skeptics, right? It does raise questions because there has been a stall within nuclear energy. And so are these deals enough to push nuclear development across the finish line? There's also the problem of storing radioactive waste, which has to be managed indefinitely. And so these ambitious plans would require deploying hundreds of its small reactors across the US to meet the energy needs. One benefit, Chris Wright, Donald Trump's nominee for Energy Secretary, currently serves on Oklo's board, and so the company's connections to Washington could prove significant. The AI revolution may be fueling a new era for nuclear power. Whether these projects will deliver remains to be seen. I'm Luke Guerrero, and this completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family members about our free podcast downloads. Get yours anytime at iTunes, Google Play, and Spotify. And while you're over there, please be sure to leave us a rate and review. Remember, we can help you better understand your portfolio dynamics and calculate your investor risk number. Just go over to InvestTalk.com and click the portfolio review button to get started. It is a free and confidential service. Also, it's not just for your IRAs, your brokerage accounts. We can also help you optimize the potential of your 401k. It all starts at InvestTalk.com. Independent thinking, shared success. This is InvestTalk. Good night.